Ladies and gentlemen, today silver did something that almost nobody in the mainstream was prepared for. On August 1st, the metal broke higher while most investors were still focused on gold, stocks, and interest rates. But here's what's even more interesting. Jamie Dimon has been warning about economic risks, debt, and market uncertainty. So the question isn't whether silver moved. The real question is this the beginning of a much bigger breakout that Wall Street still doesn't see? Let's break down what's really happening and why this could matter far more than most people realize. If you've been watching the precious metals market for any length of time, you know that silver has a habit of staying quiet just long enough to convince most people that nothing is happening. Then, when sentiment reaches its lowest point and investors begin looking elsewhere, the metal makes a move that forces everyone to pay attention. That's exactly why this latest breakout deserves a closer look. It isn't just about a price moving above a chart level. It's about what that move may be telling us regarding investor psychology, capital flows, and the broader financial environment. One of the biggest mistakes people make with silver is treating it like any other commodity. Silver certainly has industrial uses, and those are extremely important, but it also has a long history as a monetary metal. It sits in a unique position where it benefits from manufacturing demand while also attracting investors seeking protection during periods of financial uncertainty. That combination makes silver unlike almost anything else in the commodity sector. When both of those forces begin working together, the market can change far more quickly than many expect. Market sentiment is often more important than the headlines themselves. Prices don't move simply because a news story appears on television. Markets move because millions of participants collectively change their expectations. For months, many investors have remained skeptical about silver. Some have questioned whether inflation would continue. Others believed higher interest rates would permanently reduce demand for precious metals. Still, others focused exclusively on artificial intelligence stocks or major equity indexes, assuming that was where the best opportunities would remain. Meanwhile, silver quietly built a foundation. That's how many major moves begin. They rarely start with widespread excitement. Instead, they begin while most investors are still looking in the opposite direction. The strongest bull markets often emerge from periods of disbelief rather than optimism. As confidence slowly shifts, more participants begin noticing the trend. Institutional investors gradually increase exposure. Retail investors eventually return. Momentum traders join later. By the time financial media starts discussing the move every day, a significant portion of the advance has frequently already taken place. Another factor worth considering is the relationship between gold and silver. Historically, gold tends to move first during periods of economic uncertainty. Investors often view gold as the primary monetary safe haven, and once confidence builds in the precious metals sector, silver frequently follows. What makes silver especially interesting is that it has historically demonstrated larger percentage moves than gold during strong bull markets. That's partly because the silver market is considerably smaller. It doesn't take nearly as much investment capital flowing into silver to create meaningful price appreciation. This smaller market is both an advantage and a challenge. During corrections, silver can experience greater volatility than gold. Price swings can be uncomfortable, especially for investors focused on short-term movements, but that same volatility can work in the opposite direction once buying pressure increases. Understanding this characteristic helps investors avoid emotional decisions. Instead of reacting to every daily fluctuation, experienced participants focus on the larger trend developing beneath the surface. Industrial demand also deserves attention because it creates another layer of support for silver. Unlike gold, silver is used extensively across modern industries: solar energy, electronics, advanced medical technologies, electric vehicles, telecommunications, and countless manufacturing applications continue relying on silver because of its exceptional electrical and thermal conductivity. Even modest growth across these industries can create meaningful demand over time. If investment demand strengthens while industrial consumption remains healthy, those two forces can reinforce one another. Supply is another piece of the equation that often receives less attention than it deserves. Bringing new silver production online isn't something that happens overnight. Mining projects require years of exploration, permitting, financing, construction, and development before meaningful production begins. Many silver mines also operate as byproducts of lead, zinc, copper, or gold operations, meaning silver supply doesn't always respond directly to higher silver prices. This creates a situation where demand can increase much faster than available supply. Investor psychology plays a tremendous role in every precious metal cycle. Human nature encourages people to buy after prices have already risen significantly and sell after fear has taken over. History repeatedly demonstrates this pattern across nearly every asset class. Successful investors usually work to reverse that instinct. They recognize that opportunities often emerge when assets are ignored, undervalued, or misunderstood rather than when they dominate financial headlines. Another important point is distinguishing between speculation and investment. Speculators frequently attempt to predict every short-term price movement. Long-term investors, on the other hand, focus on preserving purchasing power and building wealth over many years. Silver has historically rewarded patience more than constant trading. Short-term volatility may create excitement, but long-term trends generally determine overall investment success. None of this guarantees that prices will move in a straight line. Markets never behave that way. Pullbacks are normal, corrections are healthy. Even the strongest bull markets experience periods where sentiment temporarily weakens before continuing higher. That's simply how markets function. Investors who understand this are less likely to panic during temporary declines and more likely to evaluate the bigger picture objectively. The broader economic backdrop also remains important. Governments around the world continue carrying historically high debt levels. Central banks constantly balance economic growth, inflation, employment, and financial stability. Currency purchasing power remains an ongoing concern for many investors. These aren't short-term issues likely to disappear within a few months. They represent structural challenges that can influence investment decisions for years to come. Precious metals have historically attracted attention during periods when confidence in traditional financial assets begins to weaken. Ultimately, this breakout should be viewed as more than a single day's price action. It may represent an early indication that market sentiment towards silver is beginning to shift after an extended period of skepticism. Whether that trend continues will depend on multiple factors, including investor participation, industrial demand, monetary policy, and broader economic conditions. But experienced precious metals investors understand that meaningful trends often begin quietly, long before they become obvious to everyone else. The key isn't chasing excitement. It's recognizing changing conditions, remaining disciplined, managing risk responsibly, and maintaining a long-term perspective instead of allowing short-term market noise to dictate every investment decision. For years, some of the most influential voices in finance have cautioned that the global economy is becoming increasingly complex. Their concerns have varied in detail, but the underlying message has remained remarkably consistent. Investors should not assume that today's financial conditions will last forever. Periods of stability often create a false sense of security, and history shows that major shifts usually develop gradually before they become obvious to everyone. That's why warnings from experienced banking leaders deserve attention, not because they predict the future with certainty, but because they highlight risks that many investors may be overlooking. One of the biggest issues facing the global economy today is the sheer amount of debt that is accumulated across governments, corporations, and households. Debt itself is not necessarily a problem. In fact, responsible borrowing can support economic growth and investment. The concern arises when debt expands faster than the economy's ability to service it. As borrowing costs increase, refinancing becomes more expensive, interest payments consume larger portions of budgets, and financial flexibility begins to disappear. Governments around the world have accumulated enormous fiscal obligations over the past several decades. Budget deficits have become increasingly common, and many countries continue financing spending through additional borrowing. While this approach can stimulate economic activity during difficult periods, it also creates long-term challenges. Eventually, higher debt levels require either stronger economic growth, higher taxes, reduced spending, or continued borrowing. None of those choices are easy, and each carries consequences for financial markets. Another major concern involves inflation. Many people think inflation simply means prices rising at the grocery store or gas station. While that's certainly part of the story, inflation is ultimately about the declining purchasing power of money. Even moderate inflation, when sustained over many years, steadily reduces what savings can buy. For investors, preserving purchasing power becomes just as important as generating returns. Central banks have spent years attempting to balance inflation with economic growth. Raise interest rates too aggressively, and economic activity may slow significantly. Keep rates too low for too long, and inflationary pressures may become more difficult to control. It's a delicate balancing act with no perfect solution. Every policy decision creates winners and losers, and financial markets constantly adjust their expectations based on those decisions. This uncertainty is one reason many investors continue paying attention to tangible assets. Unlike financial instruments that depend on another party's promise to pay, physical assets possess intrinsic characteristics that cannot be created with the push of a button. Throughout history, precious metals have served as one example of assets that people often consider during periods of monetary uncertainty. They don't generate income like stocks or bonds, but they have historically been viewed as stores of value when confidence in currencies begins to weaken. It's also important to recognize that financial markets are deeply interconnected. A problem in one sector rarely stays isolated. Banking, real estate, government debt, equity markets, and international trade all influence one another. When stress develops in one area, it often spreads through the broader financial system in ways that are difficult to predict. Investors who focus only on individual headlines may miss these larger connections. Another factor that deserves attention is market complacency. During extended bull markets, many participants begin believing that prices will continue rising indefinitely. Risk management often receives less attention because recent experience encourages optimism. History repeatedly demonstrates that excessive confidence can become dangerous. Markets move in cycles, and periods of strong performance are frequently followed by corrections that remind investors why diversification and disciplined planning remain essential. Liquidity is another concept that becomes increasingly important during uncertain periods. When financial conditions are favorable, capital flows freely through markets. Businesses can borrow more easily, consumers spend more confidently, and investors willingly take greater risks. But when uncertainty rises, liquidity can tighten rapidly. Credit becomes more expensive, lending standards become stricter, and investors shift toward assets they perceive as more stable. These transitions often happen faster than many expect. Coursey confidence also plays a significant role in shaping investment decisions. Modern financial systems rely heavily on trust. People accept paper currency because they believe it will continue functioning as a reliable medium of exchange and store of value. If confidence weakens even gradually, investors often begin diversifying into assets they believe offer greater protection against long-term currency depreciation. This doesn't necessarily mean abandoning traditional investments. Rather, it reflects a desire to balance portfolios against multiple possible economic outcomes. One lesson repeated throughout financial history is that uncertainty never completely disappears. Different decades present different challenges. Sometimes inflation dominates. Other times, recession becomes the primary concern. Financial crises, geopolitical tensions, technological disruption, and changing monetary policies all influence market behavior. Investors who recognize this uncertainty tend to prepare rather than predict. Preparation is often far more valuable than attempting to forecast every short-term market movement. Risk management remains one of the most overlooked aspects of investing. Many people spend enormous amounts of time searching for the next winning investment, but devote far less attention to protecting existing wealth. Successful investing isn't simply about maximizing returns during favorable periods. It's equally about limiting damage when conditions become less favorable. This balanced perspective helps investors remain disciplined regardless of market sentiment. Emotions also deserve careful consideration. Fear and greed continue driving financial markets just as they have for centuries. During periods of optimism, investors often underestimate risk. During periods of uncertainty, they frequently overestimate it. Maintaining a rational, long-term approach requires separating emotional reactions from objective analysis. That is far easier said than done, but history consistently rewards patience over impulsive decision-making. Ultimately, the broader message behind these economic warnings is not one of panic, but of awareness. Financial systems evolve continuously, and today's environment presents a combination of high debt, persistent inflation concerns, shifting monetary policies, and global economic uncertainty that deserves careful attention. Rather than reacting emotionally to every headline, investors benefit from understanding the larger trends shaping the financial landscape. By focusing on diversification, preserving purchasing power, managing risk responsibly, and maintaining a long-term perspective, they place themselves in a stronger position to navigate whatever economic conditions emerge in the years ahead. The most important question isn't whether silver has already made a significant move. The more important question is what comes next, because that's where investors often make their biggest mistakes. Human nature encourages people to believe that whatever happened yesterday will continue indefinitely. If prices rise sharply, many assume they can only go higher. If prices decline, many expect the weakness to continue forever. Financial history repeatedly proves that neither assumption is reliable. Markets move in cycles, and understanding those cycles is far more valuable than reacting emotionally to every headline or every daily price fluctuation. One thing experienced investors learn is that breakouts deserve attention, but they also require confirmation. A single day of strong price action can certainly attract interest, but lasting trends are built over weeks and months as buyers continue stepping into the market. That's why patience remains one of the most valuable tools an investor can have. Instead of assuming that every rally immediately turns into a major bull market, disciplined investors watch whether higher highs and higher lows continue forming over time. Consistency matters far more than excitement. Another factor to watch closely is investor participation. Healthy bull markets rarely depend on a handful of buyers. They broaden over time as different groups begin recognizing the opportunity. Early participants often include long-term investors who have been patiently accumulating during periods of weakness. Institutional investors may gradually increase exposure as confidence improves. Eventually, retail investors begin paying attention after seeing sustained price appreciation. By the time the general public becomes enthusiastic, a significant portion of the move has often already occurred. Market psychology plays an enormous role during this transition. At first, many observers dismiss the rally as temporary. Then skepticism slowly turns into curiosity. As prices continue strengthening, disbelief becomes acceptance. Finally, optimism can evolve into excessive enthusiasm. Understanding these emotional stages helps investors avoid chasing prices near emotional extremes. The goal is not to buy because everyone else suddenly becomes excited. The goal is to recognize changing conditions before widespread optimism dominates market sentiment. Another important consideration is the relationship between silver and the broader economy. Unlike many commodities, silver benefits from two different sources of demand. Industrial consumption remains an important driver because silver possesses unique physical properties that make it difficult to replace in numerous applications. Electronics, renewable energy technologies, medical equipment, telecommunications, electric vehicles, and advanced manufacturing all rely on silver to varying degrees. Continued technological development supports long-term industrial demand regardless of short-term market volatility. At the same time, investment demand creates another powerful influence. During periods of economic uncertainty, investors frequently reassess portfolio allocations. Concerns surrounding inflation, currency purchasing power, government debt, geopolitical tensions, and financial market volatility often encourage diversification into tangible assets. When industrial demand and investment demand strengthen simultaneously, the market can become considerably tighter than many analysts initially expect. Supply conditions also deserve close attention. Many people assume higher prices automatically create more production. In reality, mining operates on much longer timelines. Discovering new deposits, securing permits, arranging financing, constructing infrastructure, and bringing new mines into production often require many years. Even when prices rise substantially, immediate increases in global supply remain limited. Furthermore, much of the world's silver production comes as a byproduct of mining other metals such as copper, zinc, lead, and gold. That means silver output doesn't always increase simply because silver prices improve. Another development worth monitoring is physical demand. During periods of heightened uncertainty, investors sometimes shift from paper investments toward physical ownership. Bullion coins, bars, and other investment-grade products can experience increased demand when